You don't vote for these people, and you'll never see their names on a ballot. Still, they own more of your life than you might realize. Your home, your job, your data, and sometimes even the politicians you think represent you. They don't build products or sell services. They just move money around, and somehow that makes them more powerful than presidents. In modern America, money doesn't just talk, it governs. Welcome to Monetary Literacy Channel, where money, power, and history collide, and where nothing is ever quite as simple as it looks. Most folks have heard the term hedge fund, but honestly, not many know what it really means. The name sounds like a cross between a legal loophole and a lawn service, but behind it lies one of the most influential ideas in modern finance. At its core, a hedge fund is a private investment club for the wealthy. It's a big pool of money collected from rich investors, pension funds, and corporations, all managed by a small team whose only mission is to make as much profit as possible by any legal means. Unlike regular investment funds that face tight rules and oversight, hedge funds operate with almost no regulation. A mutual fund, the kind most people invest in through their bank, has to follow the rules. It can't take extreme risks and must publicly report its holdings. It's like driving down a well-marked highway. A hedge fund, though, takes the back roads at full speed. It borrows money to multiply bets, trades complex contracts called derivatives, and even finds ways to profit when markets crash. Now, a derivative might sound complicated, but it's actually simple. It's just a financial bet about the future. You're not buying the thing itself, like oil or a stock. You're betting on what its price will be later. It's like wagering on whether it'll rain next week, except those bets can be traded for real money. And that's where hedge funds thrive, in a world built on speculation, speed, and secrecy. The first hedge fund wasn't nearly this reckless. It was started in 1949 by Alfred Winslow Jones, a soft-spoken sociologist who only wanted to reduce risk. His idea was simple. Buy some stocks he thought would rise and bet against others he thought would fall. But how do you make money when a stock goes down? You borrow it. Let's say you borrow a share worth $100 from your broker, sell it immediately, and later buy it back for $60. You return the share, keep the $40 difference, and that's your profit. But if the price goes up instead, you still have to buy it back, which means you lose money. It's legal, common, and very risky because your losses have no ceiling. The stock can keep rising forever. Jones used that trick to hedge his portfolio and protect himself from market swings. It was cautious, clever, and even a bit academic. But over time, that idea evolved into something else entirely. An industry built on leverage, secrecy, and power. By the 1980s, America had stepped into a new financial era. Deregulation was the word of the day. Reagan's administration loosened the rules, the Federal Reserve beat down inflation, and suddenly Wall Street was overflowing with cheap debt. Practically overnight, anyone who could borrow could multiply their bets. And hedge funds were built for exactly that moment. They weren't banks, so they didn't need banking licenses. They weren't public companies, so they didn't have to reveal much. They operated in this strange gray area, mostly invisible to regulators but deeply connected to the financial system. If a regular investor was playing chess, hedge funds were playing poker with other people's money at a table most of the public didn't even know existed. By the 1990s, their power had exploded. Hedge funds were trading everything: currencies, bonds, stocks, commodities, even entire countries. When George Soros and his hedge fund Quantum bet against the British pound in 1992, they took on an entire nation. The Bank of England lost, and Soros made over $1 billion in a single week. One private investor had just moved a national currency. That wasn't just market power. That was empire-level influence. Then came the wake-up call. Long-Term Capital Management, or LTCM. Founded in the 1990s by Nobel Prize-winning economists, it was supposed to be the ultimate hedge fund. Its models were so advanced that its founders believed crises were basically impossible. But in 1998, when Russia defaulted on its debt, the dominoes started to fall. LTCM's massive bets collapsed, threatening to take global markets down with them. The Federal Reserve had to step in and organize a private bailout worth $3.6 billion to stop a total meltdown. That was the moment hedge funds learned a hard but valuable lesson. If you're big enough, the system will save you. From then on, risk wasn't something to fear. It was something to manage, negotiate, and even weaponize. After that, hedge funds stopped just playing the markets. They started shaping them.
They realized they could influence not just prices, but policy itself. In the 2000s, hedge funds went from niche tools for the wealthy to trillion-dollar powerhouses. They hired former government officials, donated to both political parties, and lobbied for laws that favored complex financial products. Their favorite tools? Leverage and derivatives. Think of them as the jet fuel and dynamite of modern finance. With them, even a small fund could control billions in assets. Here's how. Imagine you have $1 million. You could buy $1 million worth of stocks, sure. Or you could use that $1 million as collateral to borrow another $9 million and buy $10 million worth of stocks instead. If prices go up 10%, you don't earn 10%. You earn 100%. But if they fall 10%, you lose everything. That's the hedge fund model in a nutshell. High risk, high speed, high reward, all powered by other people's money. And when those bets go wrong, the shockwaves ripple through the entire economy. When the housing bubble burst in 2008, hedge funds once again found a way to turn disaster into profit. One manager, John Paulson, saw the collapse coming, but instead of warning anyone, he created a financial product that paid off when mortgages failed. He made about $20 billion while millions of Americans lost their homes. That was the same year the financial system nearly imploded. And yet, somehow, hedge funds walked away richer than ever. The message couldn't have been clearer. You can short the American dream itself and still win. After the crisis, new rules hit the big banks. They were forced to tighten up, report more, and take fewer risks. But hedge funds? Being private, they largely slipped past those regulations. They saw an opportunity and filled the gap. Suddenly, they weren't just traders. They became lenders, landlords, and even political power brokers. They started buying homes straight out of foreclosure auctions, sometimes whole neighborhoods at once. The houses that used to belong to families were turned into corporate rental portfolios. By the early 2020s, hedge funds and private equity firms own hundreds of thousands of single-family homes across the U.S. In some cities, 1 out of every 5 rental houses belong to an institutional investor. For ordinary renters, that changed everything. You no longer rented from a person. You rented from a spreadsheet. A computer somewhere in New York or London decided how much you'd pay, how fast your rent went up, and whether you could stay. And if you tried to push back, good luck figuring out who actually owned your home. The paperwork would trace through layers of shell companies across several states and a couple of tax havens. It's not corruption. It's architecture, built to keep power untraceable. And that's only one piece of it. Hedge funds didn't stop at real estate. After 2008, when banks pulled back from risky lending, hedge funds moved in and took their place. They started lending directly to companies, financing takeovers, even helping struggling governments. This shadow banking system became known as private credit. Picture it this way. Your local bank turns you down for a loan, but a hedge fund says yes, at double the interest. They lend when no one else will. They charge more, and if you can't pay, they take ownership.
By 2024, this private credit market had ballooned to over $2 trillion, roughly the size of Italy's entire economy. It's banking without the banks, and it's growing fast. But hedge funds didn't just stop at loans. They extended their reach into almost every market that touches daily life: energy, food, housing, currencies. During the 2020 pandemic, they made billions shorting the markets as they crashed, then billions more buying the recovery weeks later. When inflation hit in 2022, they shifted again, pouring money into commodities like oil, wheat, and metals, profiting from scarcity while families paid more for groceries and gas. They don't just bet on the future, they help create it. When a hedge fund takes a massive position, markets move, prices shift, and policies react. Even central banks take notice. Hedge funds have effectively replaced regulation with reaction, bending the rules of capitalism through sheer speed and scale. Money alone doesn't explain how much control hedge funds have. Influence does. They've become some of the most politically connected organizations in America. They're among the biggest donors to both major parties, and their executives show up at private retreats with lawmakers. They hire former Treasury officials as advisors, and in some cases, they even have direct lines to central bankers. It's called the revolving door. Here's how it works. The people who make the financial rules often end up working for the firms that profit from them. It's not illegal. It's just incredibly effective. A regulator retires, joins a hedge fund, and then starts lobbying the same agency they once led. The cycle keeps power steady, not limited. New laws aren't written to restrain hedge funds, but to make sure their world stays stable. And that's really the genius of it. Hedge funds don't just take advantage of the system. They've built one where they can profit from both stability and chaos. When the markets are calm, they collect steady returns. When a crisis hits, they flip the table and bet against everything else. Either way, they win. In that sense, they've turned disaster itself into a business model. Take derivatives, for example. The same bets on future prices that started as tools for managing risk. They've now grown into markets of their own, stacked with trillions of dollars in contracts that rest on top of other contracts. There are derivatives for interest rates, for the weather, even for natural disasters. Some hedge funds now sell catastrophe bonds, insurance-linked investments that pay high returns unless a major disaster strikes. If it does, the investor's money covers the losses. So yes, they're literally betting on the climate. This logic goes far beyond Wall Street. Hedge funds don't just play in markets anymore. They own the data that drives them. They buy satellite images to track oil tankers, thermal sensors to measure factory output, and even credit card records to predict how people will spend or vote. Their algorithms digest millions of data points and forecast human behavior before it happens. It's financial surveillance, totally legal and astonishingly powerful. Traditional finance looks backward, analyzing last quarter's results. Hedge fund finance looks forward. It's about predicting the next move before anyone else can. Some analysts even call them the new intelligence agencies of capitalism. And honestly, they're not wrong. Hedge funds don't need to control governments. They just need to know what governments will do a few seconds before everyone else. Still, their real power isn't in headlines. It's structural. When hedge funds own major pieces of a country's housing market, corporate debt, food supply, or energy infrastructure, they don't need to make threats. Their existence alone becomes leverage. Try to pass rent control, and capital flows out. Regulate derivatives too tightly, and liquidity vanishes. Punish speculation, and pension funds, many of which invest in hedge funds, take a hit. The entire system is built to keep money moving, no matter who suffers when it stops. And here's the uncomfortable truth. Your retirement fund is probably part of it. Pension plans, endowments, and charities invest in hedge funds for better returns. So the savings of teachers, nurses, and city workers often end up fueling the same forces that drive up housing costs and commodity prices. It's a loop, public money feeding private power. The most unsettling part of all this is that hedge funds don't see themselves as villains. Many of them genuinely believe they're the realists in the room. They'll tell you they provide liquidity, efficiency, and innovation. They claim they make markets smarter, and in some ways they do. They spot inefficiencies, allocate capital faster, and expose weak businesses. But their success depends on one simple truth that history keeps teaching us. Power always concentrates until it breaks. Empires rarely fall because they run out of money. They fall because they run out of balance. We've seen this story before. In Renaissance Venice, merchant guilds became so powerful they rivaled kings. The East India Company built an empire so vast it ruled entire countries with its own private army. And now, here in the 21st century, the new empire isn't built on ships or spices. It's built on leverage and data. Hedge funds are today's trading companies, private sovereigns in a world where capital moves faster than law. They don't raise flags, they raise margins. They don't declare wars, they finance both sides. They don't need to conquer nations when they can just buy their debt. That's the quiet control of modern America. While politicians argue on TV about ideology, the real players are quietly arbitraging it. They fund campaigns, trade policies, and profit from every headline that stirs the markets. In a world where every crisis can be traded, even truth itself becomes just another variable. The danger isn't that hedge funds exist. It's that the entire system now depends on them. They're woven into the economy like veins of liquidity. If they disappeared tomorrow, markets would freeze, credit would dry up, and governments would panic. That's how deep the dependency runs. So when people ask who really controls America, the answer isn't in the White House or on Capitol Hill. It's in the quiet offices of Greenwich, Connecticut, inside spreadsheets and algorithms that can shift the fate of nations before most of us finish breakfast. Empires used to conquer land. Now they conquer liquidity. The tragedy isn't that we lost democracy to corruption. It's that we traded it away, piece by piece, for convenience, until control no longer needed permission. History doesn't repeat, but the pattern is familiar. A new ruling class emerging, not through politics, but through control over debt, data, and desire. And every empire built on leverage eventually learns the same hard lesson. You can't short the system forever. If this gave you a new perspective, hit subscribe. History has the answers. You just have to know where to look.